Today we look at mortgages explained simply. We're going to be covering such topics as what even is a mortgage, through to the common jargon. We're going to be covering a lot, and it's really designed as a beginner's guide for those who are just starting their journey. It's all tailored for the Australian market. So if you end up liking this video, please hit that like button as it really helps out. And remember to subscribe to keep up to date all things property and finance. What is a mortgage and how does it work? Well, in short, a mortgage is a residential home loan secured against a residential property. But let's back up a little bit. So we've all probably had a personal loan or a car loan before, and they're pretty simple. How they work is that you get a loan from a bank, let's call it $10,000, and you get to buy a car. And essentially what the bank does with the personal loan is they get to take security over the car. So if something were to happen, they can repossess it, sell it for whatever it is, say $15,000 in this case, and then pay off the debt. Now, a home loan is exactly the same, except in this case, we have a residential property. So, for example, we might have a home worth $500,000 and the loan that the bank will give you is $400,000. So if something were to happen, in this case, the mortgage being $400,000, it being secured with a property worth $500,000, they can do the exact same thing, whereas to sell the property for $500,000 and pay off the debt and recoup any losses incurred. That is the essence and the basic of what a mortgage is. Now we know what a mortgage is, let's look at how it works. It essentially starts with a lender or a bank who provides funding. We'll denote them as a money sign. This lender or bank then allows and facilitates money lending to a borrower. And this is where you come in. With a little smiley face, this is a borrower. So the bank lends money to the borrower, who then can facilitate a transaction to purchase a home. Once this transaction is facilitated, the borrower, in this case, then pays back the bank with monthly repayments. Once all those monthly repayments are complete, then they no longer have a loan and they own the home outright. And this, in its core essence, is how a mortgage works, with two parties, primarily the bank and the borrower, who facilitate lendings to enable the borrower to purchase a home. What does a 95% mortgage mean? And this is a great question, and for many, a little bit confusing. So let's look at how this works. So 95% loan or mortgage is essentially referring to the value of the property. So let's take a look at an example here. We've got a home worth $100,000 at a 95% loan to value ratio. And we're going to explain what a loan to value ratio, what that means in a moment. But a 95% mortgage would be 95% of the value of the property, or in this case, $95,000. Now, there's many terms that are thrown out, 80%, 70%, and it's always in this same context. It's the percentage of your property versus the percentage of your mortgage. And this is what loan to value ratio means. So now looking into loan to value ratio, you've got its LVR for short, and it's essentially the loan, in this case $95,000, over the home, in this case $100,000, equals 95%. And they work hand in hand. So if you see on a bank or lender's website where they're saying this offer is only available for an 80% loan to value ratio, now you know exactly what that means. The next basic bit of knowledge you want to learn is what's known as lender's mortgage insurance, or LMI for short, and is a fee paid to the bank as a result of typically not having a 20% deposit or having a greater than 80% loan to value ratio. So back again with the scenario, let's say we've got a home worth $100,000 and you want to borrow 90% or $90,000. The mortgage insurance is a one-off payable fee paid by yourself to cover the bank. Otherwise, the bank wouldn't allow you to have the $90,000 in mortgage. So let's just call the lender's mortgage insurance $4,000 in this case. In most situations, the bank will allow you to put that on top of the mortgage. So instead of having a $90,000 mortgage, it'd be $94,000, and allows you to buy the property without necessarily having to wait another 2, 3, 4, even 5 years to save up your 20% deposit. And that's what mortgage insurance is, or lender's mortgage insurance. What does principal and what does interest mean when it comes to mortgages? Well, let's take a look at a graph and it'll explain this in a bit more detail. So we've got a graph here. On this axis, we've got a loan amount, and on this axis, we've got time. Now, most mortgages will be on a 30-year term, which means that over 30 years, you pay off your mortgage. Term, you can think of that as a different way of saying how many years do you have on your mortgage. The next one is your mortgage amount. Let's say you've got a $300,000 mortgage. So a normal graph would look like this. So what that shows is that over time, your $300,000 becomes nil, and that it's paid off in a 30-year period. So now we understand that, we can look at what a principal and what an interest component is. So interest is the fee you pay for the loan you've lent. It's essentially, you can think of it like a rental cost, and essentially it's what you pay to keep the mortgage. Principal can be thought of as the payback. So a principal repayment is essentially you paying off the mortgage. This graph shows a principal and interest repayment. A portion goes to the rental of the loan and a portion goes to the payback. If you were to have an interest-only loan, for example, you'd actually find you'd never pay off the mortgage. Instead, you're just renting the mortgage, and you're never, like renting, you're never getting to keep the property. A question people ask is, can I buy a property without a mortgage? And the answer to this is absolutely you can. However, you're going to need a fair amount of cash because you'll need not only the money for the property, let's call it a $500,000 purchase, but also all the associated costs, from stamp duty to solicitor's fees. So a mortgage isn't necessary, but you're going to need a lot of cash to buy without. How much money should I save before I buy a house? Well, the short answer to this is you should always aim for between an 8 to 10% deposit. And if you're a first home buyer, this will be more than enough for you to buy your first home. If you've already bought a home, you may need a little bit more for all the associated costs like your stamp duty and conveyancing and all the associated fees, but ideally aim for an 8 to 10% deposit. And there you have it. If you found value in this video, remember to hit that like and subscribe button. Now it's over to you. Are you looking for a mortgage broker? Do you live in Australia? Well, we can help. Here at Hunter Galloway, we get home loans approved. So visit us online at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and I'll catch you next time.